everybody, and welcome to demonstration video number 1 for Learning Plan 3. In this learning plan, there are 2 chapters that we're going to be going over, Chapter 13 and Chapter 14. You'll have a total of 4 different videos. 2 of them will be for Chapter 13 and 2 of them will be for Chapter 14. So this video, I'm going to start with brief exercise 13-5. This is going to be on page 772. And I'll read the question as always, and then we'll work through it. All right. Life.com issued $10 million of commercial paper on April 1st on a 9-month note. Interest was discontinued at issuance at 6% discount rate, and what is the effective interest rate on the commercial paper? Okay, so basically, first of all, let's go ahead and do the journal entry for the note. So we're going to debit cash. We're going to also debit discount on notes payable. And the discount is going to be the $10 million times the 6% times the 9 months over 12. And then our credit will be the notes payable, which is the face amount. Alright, so the face amount of the note payable is $10 million. And the note is going to be on, the note discount is going to be on the $10 million at 6% for 9 months. So it's $10 million times 9% times 9 over 12. That should get us to had a little difficulty with the formula. Okay, and then our cash then will be the difference of the two. So we will credit note payable for $10 million, debit cash for $9.55 million, and debit discounted note payable for $450,000. Now to calculate the effective interest rate, we're going to have to I'll show you step by step. So let's list our discount, which is the $450,000 from above that we just did. Okay, and then our cash proceeds, and we're going to divide that. Let's do this here. We're going to divide it by our cash proceeds of the 9.55. So if I take that, divide it by 9.55 million, as a percentage. There you go. Okay, so our interest rate for 9 months is the 4.712. But to find the annual effective rate, we must annualize it. So by doing so, I'm going to take 4.712% and multiply it by 12 months over 9. And that's going to get me a 6.28, or we can round it to 1 decimal place or 6.28 annual effective rate. So that's how we find the effective annual rate for this problem, this was our journal entry here. And this is our annual effective rate here. Okay, so that's what we have. And that is brief exercise 13-5. I haven't seen it yet, so that's why I did that. Okay, so we're good with that one. All right, so let's move on to 13-1, which is exercise 13-1. And this is on page 773. On November 1st, 2013, Quantum Technology, a geothermal energy supplier, borrowed $16 million cash to fund a geological survey. The loan was made by Nevada Bancorp under a non-committed short-term line of credit arrangement. Quantum issued a 9-month, 12% promissory note. Interest was payable at maturity, and Quantum's fiscal period is the calendar year. For requirement 1, we are going to prepare the journal entry for the issuance of the note by Quantum. All right, so that with the issuance of that note, we're going to debit cash for $16 million, and we're going to credit notes payable for $16 million. There's the line commas in here. Okay. All right. That's it for that one. Requirement 2. Prepare the appropriate adjusting entry for the note at Quantum on December 31st, 2013. Okay, so even though we haven't paid anything on the note at year end, just like interest revenue, we have to accrue for interest expense. So we have to debit an interest expense account to record that expense, and then credit an interest payable account, because it's going to be payable later on, not at this point in time, but later on. All right. So basically, my interest expense, and let me just write it here. My interest expense is going to be the $16 million times the 12% times the 2 months over 12, because only 2 months had passed. Okay, because we did take this loan out in November 1st, so you're going to count November and December, so that's 2 months. So I'm going to put my formula in here. Times 12% times 2 over 12. And I'm going to have a 200, oh, that is, there we go. $320,000, okay, for my interest expense. Requirement 3. We're going to prepare the journal entry for the payment of the note and maturity. Okay, so now 9 months have passed. The note has come due, it just matured, and we're going to pay the full thing, the note in full. Okay, so remember that we have to take the interest that we calculated from above, right here, at year end. We have to go ahead and net it to 0, because we already accrued for it. We're not going to accrue for it again. We're not going to record it again, because I've already recorded it in our books. Okay. And then we also have to record the interest expense for the remaining 7 months that we have not yet done anything for. So we're going to take $60 million there. We're going to multiply it by 12%. And 7 months over 12 months, because the note was for 9 months. We've already accrued for 2 months at the end of the fiscal year. Now that the note has come due, we've got 7 months of interest left and we haven't yet recorded. So at this point in time, I'm going to do that here. That should come out to $1.12 million. Because we're paying off the note, we have to take that off the books. So note payable at the face amount. of 16 million. Okay, so note payable here is going to decrease to a 0. And then we're going to reduce our cash for that total amount. These here. Okay, so that's the total cash that the business paid at the maturity date for the note. Out of that 17.44 million, 16 million was the face of the note. 1.12 million was the interest expense for that current year, and then 320,000 was interest expense from the previous year that the business did accrue for and recorded as interest expense at year end. Here we are just simply basically reducing that payable account and then paying the full amount of all the interest and the note payable face amount. Okay, so that is 13-1. Continue to 13-2. Oh, okay. All right, there we go. Okay. Okay, so exercise 13-2, it's on page 773 and page 774. In 13-2, on July 1st, 2013, Ross Livermore Industries issued 9-month notes in the amount of $400 million. Interest is payable at maturity. Determine the amount of interest expense that should be recorded in the year-end adjusting entry under each of the following independent assumptions. So in your book, you'll see these assumptions here. You'll see items for interest rates. You'll see 4 different assumptions. And then the fiscal year-end. I'll just type this in here. We've got 4 different assumptions. Interest rate for this one is 12%. Second is 10, 9, and 6. Okay. And then our fiscal year end for the first one is December 31st. The second is September 30th. October 31st for the third, and then January 31st for the fourth one. Alright, so these are our scenarios here. Okay. And what I'm going to do here is I'm going to go in, and what it's asking is we're going to determine the interest expense that would be recorded at the year end, fiscal year end for each one. Okay. So for number 1, what they did was they borrowed $400 million worth of notes. It was 4 of them, and they're asking that under each scenario, what would the company be recording? All right. So for the first scenario, we got $400 million. You've got to multiply it by 12%. So it's at 12%, and it'll be 6 over 12 because it was. Let me just. So that we don't get confused where I'm getting my months from. These notes were issued on July 1st, 2013. So for the first scenario, July 1st to December 31st is 6 months. That's why I got that 6 over 12. Okay. So my formula, if I put 400 million times 12% times 6 over 12, that's the interest amount. Okay, that the company must record for scenario 1. For 2, once again, 400 million. And this is at a 10% note, a 10% rate. And the fiscal year end is September 30th. So from July 1st to September 30th, that should be 3 months. Okay. So if I do or put in my formula, let me just fix this here. These ones. Okay, there you go. Okay, so that is the interest that is needed to be recorded as of September 31st. Let me just put that in here so that. Okay, so this is as of December 31st. As of September 30th. All right. Okay. And 3. The note is at 9%, and fiscal year is October 31st. So it'll be 9% times. So from October 31st, excuse me, from July 31st to October 31st will be 4 months. Okay. So put in my formula. That would be my interest needed to be recorded as of October 31st. And then for scenario 4, once again, 400 million at 6%. And the fiscal year end is January 31st, so that looks like it would be 12 months. Okay, so put in my formula. From July 1st to January 31st is 7 months, and that's the interest that they have to record, the 14 million, as of January 31st, 2014. Okay. So that's that one. Exercise 13-2. Basically what we did was we just recorded interest for each of the different scenarios. If the company had borrowed $400 million to each under each of these scenarios, and having different fiscal year ends means different months in calculating the interest. Okay, so this next one is going to be our exercise 13-3, and this is on page 774. The following selected transactions relate to liabilities. Excuse me. Okay, the following transactions relate to liabilities of United Insulation Corporation. United's fiscal year ends on December 31st. Prepare the appropriate journal entries through the maturity of each liability. Okay, so in the book, as you can see on page 774, they gave us dates, and for each date, transactions. So we're going to go through and record each of those transactions. Okay, so under year 2013, on January 13th, negotiated a revolving credit agreement with Parish Bank that can be renewed annually upon bank approval. The amount available under the line of credit is $200 million at the bank's prime rate. Okay, so basically it's just a credit line, so there's no entry needed until a loan is actually made. It can be, or should be, it should be described in a disclosure note then. And we're all familiar with notes to the financial statements. Of course, then this will be described in the notes to financial statements. Okay. February 1st. Arranged a 3-month bank loan of $5 million with Parish Bank under the line of credit agreement. Interest at the prime rate of 10% was payable at maturity. Okay, so basically we would debit cash for that $5 million and credit note payable for the same amount. Okay, that's a February 1st transaction, and this is our January 1st transaction. I'm just going to highlight that so you can see a little better. Alright, and on May 1st, they paid the 10% note at the maturity. Okay, so that note was only for 3 months, and now that May 1st has arrived, we're going to go ahead and pay the note off. Okay, so interest expense, we have to debit. And interest expense is calculated at taking that $5 million. We're going to multiply it by the 10%. Multiply 3 months over 12. So let me put in my formula here. 10% times 3 over 12. That should get us to $125,000 for interest expense. We're going to take our note off the books because we're paying it off at the face amount, of course, of the $5 million, and then we're going to pay our cash, which is then the sum of these two. Okay. All right, so we didn't, because it's only 3 months, it didn't cross accounting periods, we didn't accrue for any interest. But let's say they had borrowed this, let's say the fiscal year end was December 31st, 2013, and they had borrowed the note on December 1st. At the end of December of that month, which is at December 31st, we would have to accrue for interest expense. But because it did not cross periods, we borrowed it in February and we paid it out in March and May, no interest accrual needed in this situation. Only if we are crossing periods, or let's say the accounting period came to an end and we have to adjust or make sure that our financial statements are accurate. Okay, December 1st is our next transaction. Supported the credit line issued $10 million of commercial paper and a 9-month note. Interest was discounted at issuance at 9% discount rate. Okay. So basically, with the credit line, okay, we took cash. It was issued at a discount. Okay, so that discount is going to be calculated as taking that $10 million times the 9% times 9 months over 12. Okay. I want more room, so I'm just going to do this here. There you go. Okay. And then because I took out a note, I'm going to say notes payable. And the face amount of $10 million. If I took my note discount, that $10 million times the 9% times 9 over 12. My discount is $675,000. So my cash flow to me will be the difference of that, which is the 9.325 million. All right, and then as of December 31st, we have to record any necessary adjusting entries. Okay, so there's only one entry, which is to accrue interest on the note here, and it's only for 1 month because we borrowed it on December 1st, and it is now December 31st. We technically had accrued interest expense, so we're going to go ahead and make that entry. Okay, so December 31st, we're going to accrue for interest expense on the note dated December 1st. So I'm going to debit interest expense. My interest expense is going to be on that $9,325,000 times 9% times 1 over 12. Well, that's here. Let's do it this way. I'll show you this way, and I'll show you the 9 million. And then my discount on notes payable will be my offset of 75,000. Okay, this is one way of doing it to accrue for the interest. Another way of doing it okay, what we can do is we can take that 9 million, 325,000, multiply it by the effective rate by 1 over 12. Okay, and what do we have? All right, so to calculate our effective rate, we've done this before in the previous problem. To take our effective rate, we have to take that 675,000, okay, which is the note, discount on the note, divided by the amount that we received in, which is 9,325,000. That's going to equal 7.2386%. Okay, that's our interest for 9 months. To find the annual or the effective interest, we're going to take that 7.2386, we're going to multiply it by 12 over 9. And that will get me to 9.6515% as the effective rate for this problem. Okay, so let me just highlight this whole thing. There. Okay. So that's how we do. There's 2 ways to do that. Then you can take, for interest expense at the end of the year, you can take that 10 million, multiply by the 9% over 112, or you can take the effective rate. And by taking the effective rate, you can take then the amount that the business received, multiply by the effective rate to get the same amount. And let's double check that here. Very close. Oh, wrong. 9, 3. 9.096515, taking it all interest here. And let's see here. Oh, everything's just going wrong. Bear with me. I'm sorry. Okay, there we go. Okay. So checking our math, we've got then the 9.325 million times the effective rate of 9.6515% for 1 month is 75,000, which is the same as taking 10 million times 9% over 1 month equals 75,000. All right, and then as of September 1st, 2014, let me just make sure that this stays what I want. Okay. We pay the commercial paper at maturity. Okay. All right, so there's going to be interest here, and then of course paying off the note. Okay, so I know that interest expense is going to be debited. I know that my notes payable is going to be taken off the books. I know that the discount on the note is going to be credited. And I know that I'm going to be paying cash, which is the maturity amount. All right. So my interest expense is going to be the 10 million times the 9% times 8 months over 12. That's going to give me to 600,000. Okay, that's the same thing for the discount. Okay. For the notes payable, we borrowed 10 million. Okay. So my cash then will also be 10 million. All right. And then once again, another way we can take that effective rate here. We can also take the effective rate that we calculated from above of 9.6515% and multiply it by the 9,325,000 to also arrive at 600,000. That's another way of doing that area for that part. Okay, so that's that for 13-3. Once again, your homework and practice problem will be very similar to this. Excuse me. Very similar to these 4 problems or exercise that we've been through. So basically what I'm going to do is I'm going to have this video, I'm going to have 3 more other videos. 2 of them are going to pertain to chapter 13. The other 2 are going to pertain to chapter 14, which is going to be on bonds. I know we did learn a little bit of bonds in chapter 6, but we're going to kind of elaborate on it in chapter 14. So, and then your test in this learning plan will be on chapter 13 and 14, just so you are aware. Other than that, if you have any questions on the homework, please email me. I'll try to get back to you as soon as I can. Otherwise, good luck, and see you in the next video.